Click the bell icon to get latest videos from Ekeeda.
Hello friends, while solving problem on retiring partner, we may come across an adjustment where amount payable to retiring partner is partly settled in cash and unpaid amount is transferred to his loan account. How to do that? That will be understanding in this question. Let us go through the question. The balance sheet of Triveni Traders is as follows. Partner share profits and losses as 5/10, 2/10, 3/10. That is 5:2:3. Balance sheet as on 31st March 2012. Liability side. Capital Naina 18,000, Nina 16,000, Dolly 8,800. Creditors 10,600. General reserve 7,000. General reserve is undistributed profit. We are required to consider this item at the time of retirement so that we can distribute this profit among all partners in their old ratio. Asset side, plant and machinery 16,000. Factory building 20,000. Stock 10,200. Debtors less RDD amount is 8,000. Cash 6,200. Nina retired from business on 1st April 2012. Here we have Nina and her profit share is 2/10. In case of general reserve, which is 7,000, we are required to divide it in the ratio of 5:2:3. So it will be Nina's share is 1,400, which will be transferred to her capital account credit side. The assets were revalued as under. Stock 14,000. Asset side, we have this item stock, which is 10,200. Revised value is 14,000. That means it has gone up by 3,800. This will be added to the value of stock. Second effect, profit and loss adjustment account or revaluation account credit. This is a gain for the firm. Factory building is appreciated by 10%. Factory building is 20,000. 10% appreciation means we are required to increase it by 2,000. 2,000 will be added on asset side. Second effect, profit and loss adjustment account credit or revaluation account credit. Reserve for doubtful debt is to be increased up to rupees 500. Already it is there 400. So we are required to add 100 rupees to RDD. Second effect will be profit and loss adjustment account debit. Plant and machinery depreciated by 10%. Plant and machinery is 16,000. We are required to reduce it by 1600, that is 10%. Second effect, revaluation account or profit and loss adjustment account debit. The goodwill of retiring partner is valued at rupees 4,000. They have clearly given retiring partner's share of goodwill rupees 4,000. And the remaining partner decided that goodwill will be returned back in their new profit sharing ratio, which will be 5:3. Very clearly they have said that goodwill will be returned back in new profit sharing ratio, that is 5:3. Therefore we are not required to think over here what will be gain ratio. Goodwill will be raised 4,000 and then it will be returned back in ratio of 5:3. We'll be doing working note for this. Nina is to be paid rupees 2,220 in cash. So that much amount of cash will be reduced. It will be having second effect. Nina's capital account debit, and the balance is to be transferred to her loan account. Prepare profit and loss adjustment account, capital account of partners, and balance sheet of new firm. The goodwill of retiring partner is valued at rupees 4,000, and the remaining partner decided that goodwill be returned back in the new profit sharing ratio, which will be 5:3. First, we'll be crediting retiring partner for this amount 4,000. Goodwill account debit to Nina's capital account 4,000. Nina's share is credited to her capital account. Nina's capital account debit 2,500. Dolly's capital account debit 1,500 to goodwill account 4,000. This is for goodwill return back. New ratio of the firm is 5:3. According to the clear information, goodwill raised is returned back in the same ratio, being goodwill return back. If we open goodwill account, position will be like this. Goodwill account debit to Nina's capital account 4,000. This entry is posted here. Posting of this entry on credit side by Nina's capital account 2,500, by Dolly's capital account 1,500. Both the side total is 4,000. Goodwill account is closed, no closing balance. It indicates that it is raised and then written off. So no goodwill will appear in new balance sheet of firm. Let us start with balance sheet. On liability side, we have capital of Nina, Dolly. This will be transferred to their capital accounts on credit side. Partners capital account credit side. Creditors 10,600. There is no adjustment on creditors. So this will be transferred to new balance sheet on liability side. New balance sheet liability side. Creditors 10,600. General reserve 7,000. This will be distributed among all partners in their profit sharing ratio, that is 5:2:3. We have calculated this. Naina 3,500, Nina 1,400, Dolly 2,100. This will be transferred to partners capital account credit side. Partners capital account credit side by general reserve. Naina 3,500, Nina 1,400, Dolly 2,100. Let us check asset side. Plant and machinery 16,000. There is an adjustment on this asset. We'll record this in new balance sheet. Amount will be recorded in inner column. New balance sheet asset side. Plant and machinery inner column 16,000. Next, factory building 20,000. There is an adjustment on this item. This will be recorded in new balance sheet. On asset side, amount will be recorded in inner column. Asset side, factory building inner column 20,000. Stock 10,200. There is an adjustment on stock. Stock will be recorded in inner column. Asset side, stock inner column 10,200. Debtors 8,400. New balance sheet asset side, it will be recorded amount in inner column as there is adjustment on RDD. Asset side, debtors 8,400. Cash 6,200. There is adjustment on cash. It will be recorded in inner column in new balance sheet. Balance sheet asset side, cash inner column 6,200. We have completed items in balance sheet. Let us proceed for adjustments. Nina retired from business on 1st April 2012 on following terms. The assets revalued as under. Stock 14,000. Here value of stock is 10,200. It is revalued at 14,000, means it has gone up by 3,800. 3,800 will be credited to profit and loss adjustment account, and this amount will be added to stock value on asset side. Stock 10,200, add increase 3,800, revalued value 14,000. Profit and loss adjustment account credit by stock 3,800. Factory building is appreciated by 10%. Factory building 20,000. 10% appreciation means 2,000. This will be added to amount of factory building. Second effect, revaluation account credit. Profit and loss adjustment account credit by factory building 2,000. Factory building 20,000. Increase in amount 2,000. It is 22,000. Reserve for doubtful debt is to be increased up to 500. It is already given 400. So we are required to increase by rupees 100. This will have one effect. Profit and loss adjustment account debit. And another effect, it will be added to RDD on asset side below the debtors. Profit and loss adjustment account debit to RDD rupees 100. RDD 400 increased by 100 so that it will become 500. 8,400 minus 500, net debtors 7,900. Plant and machinery is to be depreciated by 10%. Plant and machinery we have 16,000. 10% is 1,600. This will be debited to profit and loss adjustment account. On asset side, this will be decreased from amount of plant and machinery. Profit and loss adjustment account debit to plant and machine 1,600. Plant and machinery 16,000 less 10% depreciation 1,600. Now it is 14,400. Goodwill of retiring partner is valued 4,000. And remaining partner decided that goodwill be returned back in the new profit sharing ratio will be 5:3. We have already done working note for this. For raising goodwill, goodwill account debit to Nina's capital account. Goodwill account debit to Nina's capital account. So it will be credited 4,000 to Nina's capital. Nina's capital account credit by goodwill 4,000. For writing it back, we have entry Nina's capital account debit 2,500, Dolly's capital account debit 1,500 to goodwill account 4,000. So this will be debited to continuing partners capital account. Partners capital account debit to goodwill Nina 2,500, Dolly 1,500. Nina is to be paid 2,220 in cash on her retirement and balance is to be transferred to her loan account. Nina's capital account debit to cash 2,220, that is cash paid on her retirement. Cash opening 6,200 paid to Nina on her retirement 2,220. Now balance cash is 3,980. Let us close first profit and loss adjustment account. Profit and loss adjustment account is closed. It is showing profit 4,100. This is divided among all partners in their profit sharing ratio. Naina 2,050, Nina 820, Dolly 1,230. This will be transferred to their respective capital account on credit side. Revaluation profit is transferred to partners capital on credit side by profit and loss adjustment account. Naina 2,050, Nina 820, Dolly 1,230. Let us close now partners capital account. Naina's capital account is closed. Total of her credit side is 23,550. We are getting balancing figure here on debit side 21,050. This will be her closing capital. Now it will be transferred to new balance sheet on liability side. Nina's capital account total 22,220. Debit side we are getting here balancing figure 20,000, which will be transferred to her loan account. Dolly total is 12,130 after deducting debit 1,500. We are getting balancing figure 10,630. This will be transferred to new balance sheet as her capital. Capital account of Naina and Dolly is transferred here on liability side. Naina 21,050, Dolly 10,630. Nina's loan account is transferred over here 20,000. Finally, we have closed balance sheet. Assets 62,280. Liability side also we are getting the same total. It means new balance sheet is tally. In this question, we learn how to give effect to adjustment, goodwill raised and returned back. Secondly, how partner's capital who is retired can be settled partly in cash and partly by transferring amount to loan account. Thanks for watching this video. Stay tuned with Ekeeda and subscribe to our channel Ekeeda. Thank you.